I think it says on the agenda for this afternoon that I'm going to talk about the background theory, and that is indeed what I'm going to talk about. So apologies for anybody who isn't expecting a lecture of economic theory, because that's what you're going to get. Because I think it's rather important to go through some fundamentals of the theory about the way we think about the nature of banks, the way we think about the nature of credit, in order to understand the situation in which we have found ourselves post the crisis of 2008. I want to start with an observation about something which has subtly changed over the last 2 years, which is this. Certainly before the crisis, central bankers had a number of very strong beliefs, and one of them was that they should certainly not get involved in anything which involved decisions as to where credit was allocated. That was an absolutely clear no-no for a central bank. They might just have a point of view of how much credit was allocated, but they certainly had no point of view as to whether more of it for business or less for households was a good thing or not. It was said that that was getting in the way of the efficiency of the market in allocating credit. But have a quick look at this. This is a set of central banks which, since the crisis, have got involved in favouring one category of credit analysis versus another. The Federal Reserve, through its quantitative easing programme, not only purchased government bonds, but specifically purchased mortgage-backed securities, deliberately aiming to reduce the interest rate, specifically in the 30-year mortgage market. All the other examples here, however, are forms of preference specifically for business. The Bank of England introduced 2 years ago a funding for lending scheme, which was initially across the board, but is now, and these words are taken directly from the Bank of England, designed so that there are incentives for lending skewed towards SMEs by discouraging lending towards housing. The ECB has just introduced, not all that successfully, it has to say, in terms of take-up, what are called targeted long-term repo operations, which are essentially a carbon copy of the Bank of England funding for lending scheme. And again, it is not available for mortgage lending. It is available for SME lending. You might be less surprised to see that the People's Bank of China, in its lending facilities, has specific preferences, lending to agriculture and small business. The Bank of Korea, however, also in its stimulus package in July said, we are stimulating lending to small business. Now, what this is quite a significant shift in central bank philosophy. And broadly speaking, I would say that most central bankers around the world believe that this is temporary, this is unfortunate, this is driven by an extreme post-crisis environment, and that sooner or later we'll get back to normal and we'll be able to get back to a completely neutral point of view. I don't think we will get back to a neutral point of view. And the crucial message I'm going to say today is that monetary policy and central bank policy, and perhaps also, therefore, fiscal policy and tax policy, has to have a point of view not only about the amount of credit created within an economy, but the allocation of credit between alternative ends. Now, I'll end with that, but let me begin the story by saying, why did we get into the crisis of 2008, and why has recovery from the crisis of 2008 been so slow and difficult? And it's always important to remind ourselves what a catastrophe 2008 was. In many countries, we are only just returning, and in some countries we have not returned, to the level of GDP per capita that we were at back in 2007. And in terms of, as we know, average real wages, and particularly real wages towards the bottom end of the distribution, it is even worse. This is, the last 7 or 8 years, the biggest setback to the success of the market economies since the 1930s. Indeed, if you look at the British figures going back to 1830, there is only one other peacetime decade in which there has been no increase in GDP per capita. But we are likely to see that between 2007 and 2017 in the UK. So it's a catastrophe. Why has it occurred? The story is often told that this was because governments were profligate, they spent too much money, and then we had a crisis. I believe that the most fundamental reason is the growth of credit to the private sector of the economy. This is a chart taken from Carmen Reinhardt and Ken Rogoff's latest paper out in November, and it tracks private credit to GDP, so this is credit provided to the private sector, whether by banks or via the capital markets, for the average of all the advanced economies going back to 1950. And as you can see, back in 1950, that was about 50% of GDP, and by 2007, it had reached 170% of GDP, with a significant acceleration after the mid-1990s. Now, this is a very, very major change in the structure of our economy. Whether you think it's good or bad, you'd certainly be very interested in it. It's clearly a different economy which has this amount of credit than one which doesn't. But before the crisis, I would say the predominant attitude of academic finance and economics towards this was that it was either positively benign or that it was entirely neutral. The benign point of view was set forward by what I might call finance theorists, people who work in the finance departments of universities, who would sometimes think about why do we have debt contracts. Now, there are some interesting issues in moral philosophy, in Islam, in medieval Christianity, and Aristotle about why you have a debt contract where you have to pay me back whether or not your business project is successful or not, and that is why a variety of moral philosophies have not liked the idea of what is called a non-state contingent contract, a contract which doesn't change according to the success of the project which it finances. But finance theorists and economic historians set out an argument that says we need debt contracts. We need debt contracts as well as equity contracts because their very fixed nature, the very fact that you are not dependent on the success of the project for your return, helps mobilize capital that one wouldn't otherwise have been mobilized. So the argument is 19th century takeoff of market economies, the development of railways, etc., would not have happened unless we could have debt bonds as well as equity contracts. And I have to say, I think it's a fairly convincing argument that we need debt contracts as well as equity contracts, that if we'd simply sat saying, okay, we're going to fund investment either entirely out of the state or in the private sphere entirely by people making equity commitments, we'd have had a much lower rate of growth than we actually achieved. And that theoretical argument was also supported by empirical evidence that people said financial deepening is a good thing. They said it's better to have a big financial sector, and in particular that it's better to have a higher degree of private sector credit as a percent of GDP. So that, for instance, if you look at a study by, for instance, the economic historian and economist Ross Levine in 2005, reviewing all the literature, he said, broadly speaking, we have positive correlations between private sector credit to GDP and growth. However, there was one thing wrong with those correlations. What they actually told us is that it's better to have 50% than 10%. If you actually look at what the empirics told us, it was that India, with only 10% GDP, private credit to GDP, would undoubtedly have a more successful economy if it had 50%. It really didn't tell us anything about whether having got to 50%, 100% was still better and 170% was still better. But let me come back to it. But broadly speaking, the finance theorists and the economic historians were telling us financial deepening, more debt to GDP is better. As for the macroeconomists, the people who develop modern monetary theory and the people who work in central banks, their philosophy basically was that whatever was happening in the financial system was just neutral and could be ignored. Now, some people are really startled by that fact, but I tell you it is true. There are things that central banks use to think about the economy called dynamic stochastic general equilibrium models. They hardly have a financial system in them. There is a great big tome of New Keynesian macroeconomic theory written by Michael Woodford called Interest and Prices, about 800 pages long. It really doesn't have a financial system in it. And if you don't believe me, Olivier Blanchard, we assumed we could ignore much of the details of the financial system. Or Mervyn King, the dominant New Keynesian model of monetary economics lacks an account of financial intermediation so that money, credit, and banks play no meaningful role. Again, quite a sort of startling point that, because you'd have thought that it's pretty obvious that interest rates work through the financial system. But there was a philosophy developed that the financial system, it was described as a veil, a sort of translucent veil through which interest rates passed to impact the real economy, but were sort of unaffected by the details of what the financial system was up to. So that was, broadly speaking, the pre-crisis orthodoxy, and that is what enabled us to look at this development and say either it was of no importance, we could just ignore it, it was no more importance in the economy than if people wanted to consume more ice cream or more cars. It was, well, that's what they want to do, but it's not macroeconomically important, or it was positively benign. But those points of view were, I think, based upon two mythologies. If you pick up an undergraduate textbook of economics, or indeed many advanced textbooks and advanced papers in economics, they will tell you two things. One, they'll say banks take deposits of money from savers and lend it to borrowers. And second, they will say, or they will imply, that the vast majority of the money is lent to entrepreneurs stroke businesses who allocate that money between alternative capital investment projects. So the iconic description, which we repeat again and again, and we bring up generations of new economists at university on, is banks take money from the household sector as deposits and they lend money to entrepreneurs stroke businesses. The trouble is that as descriptions of what modern banking systems do, this is mythological and so mistaken as to be dangerous. It is wrong in two respects. First, banks do not simply take money and relend it. They create credit, money, and purchasing power. That's what banks do. At the moment they lend £100 to an entrepreneur, they put £100 into that entrepreneur's account. But that could also be for a household. At the moment where they lend money to somebody to buy a house, they put it a loan and they put the money into their account. Now that entrepreneur or that household then on the very next day probably goes and spends that money to a supplier or to somebody who's selling them a house, but the money still stays within the system. The system has more credit and more money. This is absolutely central to the way that monetary economies work. It was central to the writing of Knut Wicksell, of Friedrich Hayek, of Joseph Schumpeter, of John Maynard Keynes in his treatise on money, and it is, broadly speaking, an insight which, to an extraordinary extent, fell out of modern macroeconomics from about 1980 onwards, in what I describe as the strange amnesia of modern macroeconomics. It is fundamental. If we don't understand this, we do not understand the dynamics of how modern economies work. So that's mythology number two. The second mythology, however, is most lending is not funding capital investment. Of course, it might be. Oh, sorry, I have to point at that, don't I? But I want to focus on three conceptually distinct functions of lending, which I think are important for us to understand. We can lend money either through capital markets or through banks to finance new capital investment. That could be in non-real estate, could be in commercial real estate, it could be in residential real estate, actual new construction. It could be in human capital. Some people think of student loans as loans which support human capital investment. So there are various categories of capital investment which can be funded by new loans. But loans can also finance increased consumption. They can simply say there are some people who are either patient people and impatient people, or richer people and poorer people, and that either the patient or the rich lend money to the impatient or the poor, and it's quite important to know which of those relationships it is. And economic theory says, well, that could be good because it enables what we call intertemporal shift of consumption within the lifetime income constraint. But even if that is true, it's a very different form of lending than lending money for capital investment. But we can also lend money, and the crucial thing to understand about modern financial systems is this is what they primarily do, is you lend money for the purchase of existing assets. Now, that could be collectibles, work of art. It could be existing businesses through leverage buyout. but by far the biggest is lending money to buy real estate that already exists. And I just want to focus your attention on the fact that you could imagine a country which had a fully stable population, which for some reason was completely happy with how many houses it has, which was constructing no new houses whatsoever, and you could have very significant increases occurring in the amount of credit extended to buy existing houses, right? And indeed, in the UK before the crisis, unlike in Spain and Ireland, where there was quite a lot of new construction, that is primarily what was going on in our credit and asset price boom. It was primarily a credit and asset price boom in the purchase of existing assets. To a significant extent, modern banking systems finance a competition between ourselves for the purchase of real estate which already exists, and effectively for locationally specific real estate, which ultimately means for the land on which that real estate sits. And I'll come back to the importance of that later. Now, just to give you an idea of the figures, it's actually not easy from the figures to exactly line it up with capital investment, with purchase of existing assets, and with consumption, because the same lending can perform more of those functions. But on any reasonable basis, if you take UK bank lending in 2009, probably only 15% of it effectively funded new productive investment. The vast majority of it funded the purchase of existing assets, or it funded consumption. Now, as I say, that's not necessarily a bad thing. We may need that in our economy, but it is a bit alarming that 85% of what modern banking systems do is quite different from what our economic textbooks say they do, and from what an awful lot of economic commentary says they do. This, however, you might think, oh, well, this is Britain. I mean, we all know Britons are completely bonkers about housing markets, etc. But other sensible countries, they'll be different from this. Well, it's not true. There's a wonderful piece of work being done by three economists, Oscar Jorda, Maurice Schullerich, and Alan Taylor. Alan is based at University of California, Davis. And what they've done is they've constructed a data set of what the banking systems do in 17 advanced economies going back to 1870. And they are able to show how much of that lending is against real estate. And broadly speaking, you can see some extraordinary ups and downs which have to do with the impact of hyperinflation and wars, but sort of ignore that. Broadly speaking, from about 1870 to 1950, ignoring the amazing ups and downs of wars and hyperinflation, etc., we're sort of at about 35%. And then from the post-war period onwards, the percent of what banking systems do, which is devoted to real estate, goes up and is now at about 60% for all banking systems across the rich, developed world. And this, by the way, is just residential real estate. You've got commercial real estate lending on top of that. And the conclusion, which Taylor, Schullerich, and Jorda reach, is the following. With very few exceptions, the bank's primary business consisted of non-mortgage lending to companies in 1928 and indeed in 1970. But by 2007, banks in most countries had turned primarily into real estate lenders. So again, they make the point I'm making. The intermediation of household savings for productive investment in the business sector, the standard textbook description of the role of the financial sector, constitutes only a minor share of the business of banking today. Now, whatever our point of view on that, it's good things or bad things, we need to understand it. We can't understand the way modern capitalist monetary economies work without understanding that. Why is this so important? Well, the reason why it's so important is where the majority of lending is against real estate, and where in particular real estate is to a degree locationally specific and in scarce supply, right? Everybody wants to live in the nicer part of towns if they can afford to, or we're in a reasonably densely populated country where we're not going to just build more and more on the green belt. In that environment, the extension of credit tends to produce a very strong reaction of asset prices. And indeed, what we get is these amazingly strong credit and asset price cycles, where the amount of credit which extended increases the asset prices, which then induces, both in the minds of the borrowers and lenders, a further acceleration of the cycle. The inner circle is on the borrower side. The more that the price of real estate, whether it be houses or commercial real estate, goes up, the more that people expect there to be future increases in real estate, and therefore the more they want to borrow, either to make money out of it or simply in order to not losing money out of it. The classic, I've got to get on the housing ladder because otherwise I'm going to lose out motivation. And then on the outer wing, increased asset prices mean that for a time nobody's defaulting on credit to real estate. Therefore, the loan losses incurred by banks are low. Therefore, banks feel more confident. Therefore, they have also an increased capital base because they're making more profit. Therefore, they arrive at favorable assessments of credit risk. Therefore, they're willing to lend more. These cycles are absolutely fundamental. They are not part of the story of financial instability. They are again and again and again the story of financial instability. We get the upswing of the cycle, and then the red cycle is just the same in reverse. What happens in the downswing? This is the pattern before the crisis. You can see house prices going up because household debt as a percent of GDP goes up. And as I say, if we look at the causes of financial crisis, certainly over the last 30 years, it is fundamentally credit and real estate prices. That is the cause of the Japanese financial crisis of 1990, the Scandinavian financial crisis of the early 1990s, the Texas of the early 1980s, the Massachusetts of the early 1990s, and the latest. It's just the pattern repeats again and again and again. I want to say one final thing, however, about this, which is, why are modern economies so real estate intensive? And the story I want to tell is part of the reason why is not going to go away. Modern economies are going to be more real estate intensive, but we have to realize that once the general natural tendency for that to occur is observed, the system has a tendency to take it to excess. Let me explain what I mean. First of all, let me point out that the value of real estate is fundamental to modern economies. Many of you, I'm sure, have read Thomas Piketty from the beginning to the end. Now, what is interesting about, and this chart is taken from Thomas Piketty's, very, very fine. I think Capital in the 21st Century is a huge contribution, an amazing database he's pulled together. You don't have to agree with every bit of his analysis to admire an extraordinary piece of empirical economic analysis. And what Piketty, of course, has pointed out is this fascinating move in the ratio of wealth to national income. Wealth to national income used to be about 700% in the 19th century, fell to sort of 200–300% in the 1920s, and then is going back to the sort of 500–600% that we saw in the 19th century. That is a crucial part of the Piketty story. What I think he has not adequately focused on, and I've exchanged emails with him saying, well, why didn't you stress this point? Because it's in your own figures, is that the vast majority of the increase in the wealth to income ratio is explained by this green band, and this band is housing. We see over the previous 2 centuries a collapse in the importance of agricultural land as a source of wealth, but we see from the 1950s onwards a relentless increase in the importance of real estate as a percentage of wealth. And indeed, if you look at all the figures, even for countries like Germany that we think of not having big real estate booms, one finds that the majority of the increase in the wealth to income ratio, which Piketty has set out, is always explained by real estate. And fundamentally, it's not explained by the construction of real estate, it's explained by the increase of the land value. I am fortunate enough to live in a very nice house in London, which is now worth something like 7 times what I paid for it in the early 1990s. There isn't a brick has been changed. I put in a new kitchen, but that's not why it's gone up 7 times. This somewhat small patch of land, it can be no bigger than this room on which my house sits, in fact it's considerably smaller than this room, has somehow gone up enormously. This story of the value of urban land is fundamental to modern economies. Why is this going on? I think what we have is an interface between three factors. The first, I think we have to accept that the desire to compete with one another for the ability to live in the nicer part of town, or to stay at the hotel, which is closer to the beach, or is closer to the skiing piste, or closer to the center of town, if that's what you like doing, is a high income elasticity activity. That as people, either in general across society or in the upper half of the income distribution, reach something like satiation in how much food they have or how many clothes they have, they will devote an increasing proportion of their income to essentially competing with other people for the right to live in the nicer rather than less parts of town. So part of it is a high income elasticity of demand, which I suspect means that even in the absence of any credit system, would be likely to produce an increase in the wealth-income ratio as it relates to real estate. So partly it's naturally arising. We're not going to avoid that. Modern economies are going to be real estate intensive. The very same processes that keep the value of this continually collapsing as a result of technological advance, which means that there's a limit to how much money, however hard you try, you can spend on iPads and mobile phones, etc., means that you devote more of your money to, paradoxically, the least high-tech thing of all, which is land, which is why I call the modern economy the high-tech, high-touch economy. The more high-tech it is, the more we value the things whose value does not collapse because of technological progress. The trouble is that the moment we all observe that that's going to occur, land becomes an investment asset, because the very fact that it is likely in some way to go up faster of income makes it logical for people to say, well, I better get into that, or I better buy 2 of them, or I better buy 3 of them, or I better be a buy-to-let landlord. And therefore, it becomes an investment asset class. But it is also an investment asset class which is the easiest thing for banks to lend money against, because when you lend money to a business proposition, you've got to sit down and do some analysis of the business proposition. When you lend money against a house, you can, if you want, lend money simply against the value of the house, the collateral of the house. So we have a tendency, and let's remember that banks can create credit, money, and purchasing power. And so we end up with an inelastic supply of locationally specific land, and a potentially infinite supply of credit and private money creates an instability at the center of our financial system and of our modern economies. I think this is fundamental to understand, but the bit we're focusing on today is where credit and private money comes into it. So that's my story of what is the core of instability. But let me make 2 things clear. Why does the growth in leverage matter? And how is it possible without stimulating inflation? I should have mentioned earlier, when I mentioned the point of view of the macroeconomists, that the rise in credit was neutral. They basically said it's neutral as long as there isn't inflation, right? So they observed that growth of private credit. They said, well, the growth of private credit's occurring, but as long as the inflation rate is only about 2%, then we're in the middle of a great moderation. And indeed, they had a thesis that I'll come back to as to why, as long as they were hitting price stability, it must be the case that credit, however much credit, was a good thing. So that's the second question I'm going to ask. But first I want to be clear, why does this growth in leverage matter? I mean, obviously, it can produce the green cycle and the red cycle, but why is that more than a cycle? Why have we ended up in this deep post-crisis recession? The essence is what I call, well, what lots of people call the debt overhang. And I think the fundamental reason why we are now 6 years into this recession and have such low growth is the debt overhang effect. Let me explain what that is. We ought to have understood that it was going to occur because we had a canary in the mine, and the canary in the mine was Japan. Japan in the 1980s had a huge credit and real estate boom. Some of you may remember those mythological stories of about 1988 where somebody who'd worked out that the value of the land of the imperial palace, if you could only build high-rise offices and hotels on it, was worth more than the whole of the state of California. Probably an urban myth, but even though that was an overstatement, extraordinary value of land in urban Japan, in particular Tokyo, are all funded by credit. And what you had was a set of private non-financial corporates, PNFCs, who were borrowing money, the red line here, a sector financial deficit, borrowing lots of money, and even companies whose fundamental business was electronics or cars were saying, why don't I get into a bit of commercial real estate development on the side? It was a absolutely crazy credit and asset price boom. What happens in about 1990 is that the boom turns to busts, and that the real estate prices, having gone up 4 times, fall 80%. They fall back to where they were. And the crucial thing is what happens to the red line. What you have is a whole load of corporates which now feel that they are over-leveraged. They feel, oh my God, I've borrowed all this money against real estate, the value of real estate has collapsed, and because it's collapsed, I'm now determined to do one thing, which is to pay down my debt. And I pay down my debt by not investing, by converting my cash flow in an attempt to pay down my debt. It's what's called, what Richard Koo in a very fine book calls a balance sheet recession. The corporates become focused not on decisions at the margin about innovation or new investments. They get focused on their balance sheets. They want to cut their investment. That pushes the economy into a recession. The offset, however, naturally arising and essential, is the blue line, because when the economy goes into recession, the public deficit moves from a surplus into deficit because unemployment benefits go up and taxation receipts go down. And not only does that occur automatically, but according to Richard Koo and others, it was a good thing that it happened, because if it didn't happen, Japan would have faced not just a decade of low growth, but an absolutely massive Great Depression. Because remember, there are basically 4 sectors here: household, corporate, overseas, and government, and they have to sum to 0, right? They can't all run surpluses. They have to sum to 0. However, there is one problem with that, which is the net implication of it is that the stock of government debt goes up. And what we can see here is the red line is bank lending to non-financial corporates, which slowly comes down as a percent of GDP as all the corporates attempt to deleverage. And the blue line is that the debt of the public sector just goes up and up and up. And Japanese government debt to GDP has now reached 230% and is still rising. Now, the deficits that the Japanese ran were important to avoid a still deeper recession, but there is still an issue of what are you going to do about the government debt that results. And that pattern, that post a recession, which is created initially by private credit creation, that post the recession, the leverage doesn't go away, it simply moves from the private to the public sector, has been repeated again and again and again over the last 5 years. So what you see here for the UK, the US and Spain is the private non-financial corporates and the households, increases in leverage before the crisis, some beginning of deleverage thereafter, but a more than offsetting increase in public debt. Essentially, once we have an excessive amount of debt in the system created by the private side, we have a major problem. We don't know how to get rid of it. We simply know how to shift it around the economy. We know how to shift it from the private sector to the public sector, or from Germany to China. China has had a huge credit explosion over the last 5 years, so have many emerging economies, but we don't know how to get rid of it. Indeed, if you look at the figures produced by the Office of Budget Responsibility for the next 5 years, what they suggest is that the only way we're going to get out of this recession is to shift it all back again to the private sector, so that they have a forecast which goes, oh yes, eventually we'll get public debt under control as a percent of GDP, but at just the point where we do that, household debt will turn around and go back up again. And indeed, you're only going to get the growth which achieves this, according to the OBR, if you get the increase of debt which does that. So my message is the reason why the leverage matters, which was my question earlier, the reason why the leverage matters, the private leverage, is once you've got it, you end up, as we have been for the last 6 years, in an extraordinarily difficult public policy space. Because it appears that you're blocked. Now, we can debate whether you're really blocked or not, but some people believe you're blocked in terms of fiscal stimulus because you're facing public debt increase. So they don't want to run large fiscal deficits because that will still further increase the public debt. So you try instead to stimulate the economy with ultra-loose monetary policy by reducing interest rates close to the zero bound, by quantitative easing, by funding for lending. And eventually, if you chuck enough at it, you'll get some sort of response. But the trouble with ultra-loose monetary policy is that its transmission mechanisms have major problems. First, they tend to create asset bubbles. Indeed, they only really work via asset bubbles. You have to increase asset prices with low interest rates, which will encourage people to then spend some money. Second, they tend to be very unequal in effect, because given that they work through asset prices, they give the benefit to people who already have assets. And third, and most ironically, they can only work, really, by eventually re-stimulating the very growth of private credit which created our problems in the first place. Now, let me be clear. If I had been on the Monetary Policy Committee of the Bank of England, I was on the FPC but not the Monetary Policy Committee, I would have voted for ultra-loose monetary policy because I think, faute de mieux, with nothing else available, it was the best thing that we can do. But ultra-loose monetary policy has significant adverse side effects. Well, we appear to be stuck. We appear to be out of ammunition and unable to have a policy which produces a good effect. Now, I happen to believe that we're never out of ammunition, that there are very few problems in economics to which there are definitive solutions, but absolute deflation is one. And intriguingly, the solution to absolute deflation is a point of economic policy where Milton Friedman and John Maynard Keynes agreed completely, and they said, faced with that environment, you do what Milton Friedman called helicopter money. You fill a helicopter with money and you scatter the dollar bills around and people will get spending again. Or you do what John Maynard Keynes said, you put pound notes in old bottles and dig them in the ground and pay people to dig them up again. Slightly odd in that respect. Keynes wasn't normally a Puritan, so you'd have expected him to go straight for the more just give the stuff out, but in that respect he wanted people to do a little bit of work en route. Milton Friedman was a bit more radical. And the question I have raised is, should we have done simply helicopter money rather than quantitative easing? I would ask you to look at these two possibilities. We have essentially done several hundred billions of quantitative easing with a commitment that at some stage we will reverse it. We have done funding for lending. We have relaxed bank and capital and liquidity standards in an attempt to get people lending again, to get the economy going. The transmission mechanisms of this are through asset prices, through more lending, etc. We could have done several tens of billions of overt money finance, what I call overt money finance, of increased fiscal deficits. You just say, I'm going to increase the fiscal deficit, and this bit of the increased fiscal deficit, don't worry how you're going to pay it back, because this is funded with permanent central bank money, and with a commitment that this will be permanent. Now, by saying, even raising this question, I put myself in a taboo space. Slightly odd taboo space, because it's what Bernanke said in 2003 in Japan. It is what Milton Friedman said in his Helicopter Money article and in 1948. But it has become taboo because people say, oh yes, but at the moment you do that, you can't trust the politicians. They won't only do 10 billion, they'll do $1 trillion, and then we'll have hyperinflation. And the argument against this is fundamentally a political economy argument. It's that we don't trust ourselves to do it in a small, responsible amount. I mean, I'm going to assert that as a fact. There are no technical arguments against doing this. It is possible. The issue is, can you construct a robust enough political economy that you're confident we won't do it to excess? But the question I pose is, which of these will be most effective in stimulating nominal demand and which would have the least adverse side effects? I think we should at least have considered option 2. I think it is difficult to imagine the Eurozone pulling out of its current problems without some variant of option 2. I think, unfortunately, there is almost no chance whatsoever that an option 2 variant will be pursued in the Eurozone, and therefore, for that reason, I am a pessimist on the Eurozone, because I think it's going to look for the next 10 to 15 years rather like Japan in the 1990s, but with the consequences of that far more adverse, because a decade of low growth and deflation in a continent of many countries, nationalist movements, ethnic and religious diversity and minorities, I think will be far more severe and dangerous than it was in a culturally and ethnically homogeneous Japan. I'm going to move on very quickly. My second question was, okay, but central banks had a concept, and the concept was, I observe this growth of credit, but it must be okay because I'm not seeing inflation, right? That was their concept. They said, okay, I accept that too much credit might be a problem, but if it is a problem, it will show up in inflation. That was the overt philosophy of inflation targeting. And it goes back to a concept actually by the Swedish economist, a brilliant economist, Knut Wicksell, who wrote a book in 1904 called Interest and Prices. And Knut Wicksell said, credit is extended to entrepreneurs, stroke businesses to finance capital investment. There is a marginal productivity of capital, what he called the natural rate of interest. If central banks are silly enough to set a market rate of interest which is below the natural rate of interest, entrepreneurs will go and do all sorts of wasteful capital investments, and we'll have too much capital investment, we'll have inflation. But as long as they set the market rate of interest so as to achieve stable inflation, whatever my rate of credit creation is, will be the optimal rate of credit. It will precisely produce the amount of investment that I could logically produce. And essentially, modern macro theory, though it often doesn't recognize it, is a sort of hand-me-down from Wicksell. Sometimes that recognition is explicit. Michael Woodford's Interest and Prices is named explicitly in homage to Knut Wicksell's Interest and Prices. But of course, all of that's true, or might be true to a degree, if all of credit was extended to fund capital investment by businesses. If that was the case, and you created too much credit and produced too much investment, then you'd produce too much demand and there'd be inflation, and then the central bank would respond to it. So in that environment, you could imagine that inflation targeting would be sufficient to ensure stability of the economy. But when you think about the two other elements of the nature of how we can extend credit, you realize that we can have very significant growth of credit and debt, which produces problems without that ever showing up in a higher rate of inflation to which an inflation targeting central bank responds. You might think that finance of consumption will be like finance of investment. The more there is, the more demand there is, and then we have an inflationary impact and we respond to it in time. But the reason why that may not work actually is rising inequality. Keynes argued, and I think he was wrong, that as we got richer on average, we would have a problem of secular stagnation. He didn't actually use that phrase. I think it was Hansen who first used the phrase. But he basically said, as people get richer, there's a limited number of things they want to buy, and so they'll stop buying so much and they'll start saving too much, and we'll have secular stagnation. I think as a statement about average propensities to consume, that turned out to be wrong. Because in an environment where advertising encourages new demands and new desires, in an environment where there are fashion things which you want because everybody else has them even though you don't need them, there is not much evidence that on average over time for the whole society there is a secular trend to a rise in the savings rate which gets in the way of the balance of the economy. But what is true is that cross-sectionally within an economy, richer people have a higher marginal propensity to save and a lower marginal propensity to consume than poorer people. So if we have a very significant increase in inequality, and if we did not have consumption credit, we could end up with a situation where we would have an inadequacy of demand because richer people would be trying to save stuff, and they'd be trying to save stuff above and beyond the investment needs of the economy. The system might then balance, however, because essentially rich people save it and it gets lent to middle income and poorer people. And I think part of what has been going on is that we have had an increase in credit which we have, because of inequality, we have needed simply in order to have adequate demand rather than excess demand. And there's a very fine explanation of that by Raghurajan, now the central bank governor of India, in his book Fault Lines, who argues that you have to understand the explosion of subprime credit in the USA as being essentially part of a response to rising inequality within a political culture where it is unacceptable to say, I'm going to deal with rising inequality with redistribution or minimum wages. And so as he says it, the response was, let them eat credit. And there was an explosion of credit to lower income people. But even more important, I think it's important that when we have credit which finances existing asset prices, there is no direct stimulus to nominal demand. You could imagine in the environment where I suggested earlier, that environment of a country which was building no new houses because it had stable population and had all the houses it wants, you could have a large credit creation which increased credit, money balances and asset pricing, and which had no impact whatsoever on consumption and investment, and therefore nothing for an inflation targeting central bank to respond to. Now, you might actually indirectly stimulate demand via what are called wealth effects and Tobin's Q effects, but they would not be certainly and directly proportional to the increase in credit. Therefore, when you have credit against existing assets, you can have very big increases in credit, which when they produce the crisis, then produce a debt overhang, which produces us in a very difficult environment, and you can have that without that ever, in advance, sending inflationary signals to which an inflation targeting central bank responds. What this implies in the work of Richard Werner, which I shall get to, is that we need to recognize that credit performs very different functions in our society, in our economies. What Richard has done is point out the very big increase in credit in 1980s Japan, which did not produce a big increase in Japanese nominal GDP and in Japanese inflation. And he said you shouldn't have expected it to, because there are two different correlations going on. One is this one, which is a fairly good correlation. It's not precise, because you'll see the scale is a little bit different on the two sides, between the more credit is extended to real estate, the more that the value of commercial real estate and commercial land goes up, and the more credit is extended to things that you might think of were GDP transactions, new consumption or investment, the more nominal GDP goes up. You have two correlations, not one. What that suggests in monetary theory is that, contrary to the pre-crisis belief that all that matters in low and stable inflation, contrary to that, aggregates do matter, balance sheet figures do matter, but for a completely different reason from what monetarist suggests. We need to move away from inflation targeting to an idea that monetary aggregates matter, but not because of money supply concerns, but because of what Richard has called the disaggregated, oops, why isn't this working? Hit that, the quantity theory of disaggregated credit. It's not the case that what matters here is an increase in the money stock because it has a relationship of prices times income. This is nominal GDP. Instead, we have to think of two relationships where the increase of credit extended against real estate will have, that should really be a sort of approximately equal sign. It will have some relationship to the increase of the price of real estate, and the increase of non-real estate credit to finance GDP transactions will have some relationship or nominal GDP, which of course means that the amount of money stock, which will have to be the increase in the credit if we define money to be the whole of the liability side of the balance sheet, is bound to be higher than nominal GDP, which means a fall in the velocity of circulation of money. I mean, broadly speaking, the story of monetary theory in the 1980s and 90s is that back in the 1970s, when people were struggling with inflation, they developed an idea that the money supply matters and that the velocity of circulation of money would be relatively stable. So you had to control the money supply to control inflation. And the moment they started doing that, the velocity of circulation started falling. And after about 10 or 15 years of the velocity of circulation falling, they said, well, something wrong with theory, and they gravitated to the idea that they should just do inflation targeting, and fundamentally gravitated to the idea that we didn't have to pay attention to monetary aggregates at all. I believe we do have to pay attention to monetary aggregates, but for a completely different reason from that which was in monetarism. It is not because money is a forward indicator of inflation. It's because excessive private credit creation is a forward indicator of crisis debt overhang, post-crisis depression, and deflation. Now, what does that mean for the way we have to run our economies in the future? I've suggested something about the problems of how the hell do we get out of the debt overhang we're in, and suggested the taboo option of overt money finance. But suppose we got out of it, what should we do for the future? And what does that imply for the policies that we should have had in place back in 1980 to stop us getting into this mess? It implies that we cannot have just one objective and one instrument. Low and stable inflation, I personally think, is important. I think it's better to run economies with roughly 2 or somewhere in the 1 to 3% range of inflation than with 10 or 15%. But it's absolutely not sufficient. What we know from the crisis is that we can have credit and asset price cycles, and rising leverage can produce macroeconomic instability and major harm without that ever producing an increase in inflation to which an inflation targeting central bank responds. So inflation targeting is not sufficient. I also, however, believe that the interest rate tool is not sufficient. Some people, in particular the economists around the Bank for International Settlement, like Claudio Borio and Bill White, say absolutely right with that, but they still fundamentally think we should run the economy simply by pulling the interest rate. They say what should have happened about in 2000 and 2005 is the Federal Reserve and the Bank of England should have observed the growth of credit and asset prices and should have increased the interest rate by more than seemed sensible given the inflation rate at that time. So they say not one objective, but still one instrument. Slightly oversimplifying, but that's broadly speaking. I think the difficulty with that is what I call the diversion, the heterogeneity of interest rate elasticity across the economy. What I mean by that is, once you get a credit and asset price boom going on in real estate, once commercial real estate developers and house owners or potential house owners have convinced themselves that for the next 2 or 3 or 4 years, house prices are likely to go up by 10 or 15% per annum, varying the interest rate, the policy Bank of England interest rate from 5 to 5.5 to 6 is not going to slow those guys down, and varying it from 5 to 10 is going to really cause harm in the rest of the economy long before it slows down the real estate boom. And we've seen that in Sweden over the last 2 years. From about 2011 onwards, the Riksbank, observing a credit and asset price boom emerging in Sweden, in Stockholm in particular, was trying to slow that down with interest rate rises, which were going against the trend of ultra-loose monetary policy throughout the world. It didn't manage to slow down the real estate boom, but it did manage to slow down the Swedish economy, which now has rising unemployment and is heading towards deflation. So we cannot do this by the interest rate alone. What we need is a variety of other policy tools and objectives. We need to constrain the pace of growth and the level of private sector leverage, but we also need to have a point of view about the balance between different sectors. And while not, in my opinion, demonizing lending against real estate, because I think it has a role within an economy, we have to realize that left to itself, financial systems have a skew towards more lending against real estate than is socially optimal. We have a social externality effect where the risks that that creates for the economy are not ones which the private sector will internalize. We therefore need tools such as much higher bank capital requirements, much higher counter-cyclical capital requirements, increasing the capital risk weights for real estate lending above what are called internal advanced IRB, internal risk weighting levels, the levels which private banks will sort out for themselves. We need to constrain borrowers through loan-to-income ratios, and we need to consider whether, if banks left to themselves are always going to migrate towards real estate lending, because that's the easiest thing to do we need to set up banks who only have a license to do what our textbooks say they do? Because I repeat the point, we start with a set of textbooks that say that what banks do is lend money to businesses to do capital investment, but that's not what they do. Now, just one final point. What positive money is essentially about is being much more radical than I dare to be. Right, because what I'm saying is there's this thing called fractional reserve banking, and I'm saying, which is the idea that we allow banks to create credit and private money. And they can create credit and private money because they only need to hold as base money a fraction of their liabilities. I am clearly arguing that we have allowed that fraction to be far too low, that we should not have allowed it to be 5%, it ought to be 15 or 20%. The positive money people are the people who take it to its logical extreme and say, why not 100%? Why do you allow this private credit and money creation at all? I'm along that spectrum, but I'm not that radical, and we can talk subsequently about how radical we can be. The net effect is, this isn't going to go away. Central bankers believe that having stumbled in to the realization that they have to have a point of view in order to stimulate the economy as to whether lending is more important for one sector or another, that's not just a temporary response to an extreme crisis. It is going to have to be a central part of our philosophy of central banking and of credit and monetary policy looking forward. Thank you. That was about 50% of GDP, and by 2007 it had reached 170% of GDP, with a significant acceleration after the mid-1990s. Now, this is a very, very major change in the structure of our economy. Whether you think it's good or bad, you'd certainly be very interested in it. It's clearly a different economy which has this amount of credit than one which doesn't. But before the crisis, I would say the predominant attitude of academic finance and economics towards this was that it was either positively benign or that it was entirely neutral. The benign point of view was set forward by what I might call finance theorists, people who work in the finance departments of universities, who would sometimes think about, why do we have debt contracts? Now, there's some interesting issues in moral philosophy, in Islam, in medieval Christianity, in Aristotle, about why you have a debt contract where you have to pay me back whether or not your business project is successful or not, and that is why a variety of moral philosophies have not liked the idea of what is called a non-state contingent contract, a contract which doesn't change I think it says on the agenda for this afternoon that I'm going to talk about the background theory, and that is indeed what I'm going to talk about. So apologies for anybody who isn't expecting a lecture of economic theory, because that's what you're going to get. Because I think it's rather important to go through some fundamentals of the theory about the way we think about the nature of banks, the way we think about the nature of credit, in order to understand the situation in which we have found ourselves post the crisis of 2008. I want to start with an observation about something which has subtly changed over the last 2 years, which is this. Certainly before the crisis, central bankers had a number of very strong beliefs, and one of them was that they should certainly not get involved in anything which involved decisions as to where credit was allocated. That was an absolutely clear no-no for a central bank. They might just have a point of view of how much credit was allocated, but they certainly had no point of view as to whether more of it for business or less for households was a good thing or not. It was said that that was getting in the way of the efficiency of the market in facilities, has specific preferences, lending to agriculture and small business. The Bank of Korea, however, also in its stimulus package in July said, we are stimulating lending to small business. Now, what this is quite a significant shift in central bank philosophy. And broadly speaking, I would say that most central bankers around the world believe that this is temporary, this is unfortunate, this is driven by an extreme post-crisis environment, and that sooner or later we'll get back to normal and we'll be able to get back to a completely neutral point of view. I don't think we will get back to a neutral point of view. And the crucial message I'm going to say today is that monetary policy and central bank policy, and perhaps also therefore fiscal policy and tax policy, has to have a point of view not only about the amount of credit created within an economy, but the allocation of credit between alternative ends. Now, I'll end with that, but let me begin the story by saying, why did we get into the crisis of 2008, and why has recovery from the crisis of 2008 been so slow and difficult? And it's always important to remind ourselves what a catastrophe 2008 was. In many countries, we are only just returning, and in some countries we have not returned, to the level of GDP per capita that we were at back in 2007. And in terms of, as we know, average real wages, and particularly real wages towards the bottom end of the distribution, it is even worse. This is, the last 7 or 8 years, the biggest setback to the success of the market economies since the 1930s. Indeed, if you look at the British figures going back to 1830, there is only one other peacetime decade in which there has been no increase in GDP per capita. But we are likely to see that between 2007 and 2017 in the UK. So it's a catastrophe. Why has it occurred? The story is often told that this was because governments were profligate, they spent too much money, and then we had a crisis. I believe that the most fundamental reason is the growth of credit to the private sector of the economy. This is a chart taken from Carmen Reinhardt and Ken Rogoff's latest paper out in November, and it tracks private credit to GDP, so this is credit provided to the private sector, whether by banks or via the capital markets, for the average of all the advanced economies going back to 1950. And as you can see, back in 1950, allocating credit. But have a quick look at this. This is a set of central banks which, since the crisis, have got involved in favouring one category of credit analysis versus another. The Federal Reserve, through its quantitative easing program, not only purchased government bonds, but specifically purchased mortgage-backed securities, deliberately aiming to reduce the interest rate, specifically in the 30-year mortgage market. All the other examples here, however, are forms of preference specifically for business. The Bank of England introduced 2 years ago a funding for lending scheme, which was initially across the board, but is now, and these words are taken directly from the Bank of England, designed so that there are incentives for lending skewed towards SMEs by discouraging lending towards housing. The ECB has just introduced, not all that successfully, it has to say, in terms of take-up, what are called targeted long-term repo operations, which are essentially a carbon copy of the Bank of England funding for lending scheme. And again, it is not available for mortgage lending, it is available for SME lending. You might be less surprised to see that the People's Bank of China, in its lending for